Swayam Prabha. Digital India. Educated India.
So welcome to this series on ESG analytics and green finance, and this is lecture number 15 about sustainable bonds and the various future of the capital debt markets and all that stuff. My name is Atul Tripathi and I'm honorary adjunct fellow at National Maritime Foundation. So welcome all. Now, one of the things that we're going to be talking about will be on the various taxonomies that is existing on the sustainable bond. So think of sustainable bond as two families, one specific green social project and the other is hardwiring into the issuer level sustainability. That is the focus point of the entire sustainability bonds when you look at, because the use of proceeds when you look at, or UOP, which is also called as the green social sustainability bond finance, is clearly defining the eligible projects, the alignment to ICMA. There are 4 different components. We'll talk about this ICMA and its 4 components in a few minutes again, just for a reminder for the participants. The use of proceeds, evaluation and selection, the management of proceeds and reporting. So this is the main framework of the architect types, as we call it, the sustainability bond. And then they have a performance link, the second part of the architect types, So where you're looking at sustainability linked bonds or SDG linked instruments, which are adjusting to the financial characteristics, which is often coupon or step up or step down based, on achievements based on certain preset of KPIs and STPs, and the proceeds, they can be generally used for the corporate purposes, and that's the main focus. So if you look at India's climate taxonomy, we're looking at green bonds and the sustainable infrastructure to adaptation and resilience and the social and environmental safeguarding. So that is the focus of the entire India's focus on the financial taxonomy of the green bonds. And then you come to another purpose. Why do we even need the purpose, and what are the performance factors that we need to it? So question happens to be the use of proceeds instruments when it is there. What are the funding? What is the requirement allocation? What is the impact of reporting on the project level? And the other purpose is the performance, so you have the SLB's answers. Who is the whole insurer improving? And the requirement of the material KPIs, ambitions of STP calibration, something again we'll be talking in a few minutes, just to set the context for the entire discussion for this day. Then you have the standards and the landscaping. So you have the ICMA principles, which are voluntarily global benchmarking stewarded by ICMA itself, which is an organization, and we'll look at a few use cases around it as well, where you are widely referenced by issuers, investors, underwriters for whatever is the best practices around this thing, And then you have the climate sustainability which is building on our ICMA and adding certification and assurance pathways for climate-related UOP, that is your use of proceeds and the SLB structure. So, and then finally, you have the SDG linkages, where the use of proceeds is being characterized based upon the mapping that is relevant to UN SDG goals, such as clean energy, life under sea, life on land, social development indexes, and all that stuff. And the SLBs can then be framed as SDG linked when KPIs and STPs, they're aligning with the specific SDG targets. So that is the entire taxonomy of the social bond we look at, when we look at from the perspective of the entire sustainable bonds of structure. That brings me to another point. What exactly is the bond, sustainable bond, and what is the purpose, that the performance factors, what about the pricing, how do we do that? So when you look at the capital is actually shifting from what if bonds to how it performs, and then you're looking at it from the sustainable bonds markets for the shift measurable perspectives. So you have the green loans and the green bonds, traditional lending to the bond factors. And if you look at the way this market has been growing across the world, it's a huge numbers now that we are looking at it across the world. So when the taxonomical factors, what exactly are the sustainable bonds? So the market instruments, they are channeling your capital to environment and social outcomes via 2 archetypes. One is use of proceeds, which is actually green, social, sustainability factors. And then you have the performance link, where you're looking at SLBs and SDG links, just something I talked about just a couple of minutes ago. And then you have the core design, which is around the use of proceeds and versus the SLB. So use of proceed instruments are like they're financially eligible projects, and they must articulate the use of proceeds and the project evaluation, the selection, the management of proceeds. How will you look at the post-issuance reporting as per ICMA principles? Then the SLBs, they are looking at the proceeds that can be for general purposes. What are the financial characteristics that are varying based on the achievement of predefined material KPIs, your ambitious SPTs, what is ongoing reporting, what are the external verification recommendation by ICMA, SLB guidance. Why does this even matter for the issuers and investors? That's a very fundamental question, because any issuer will be focusing on the market factor, and while the investor, the buyer, is also looking at why should I even bother to look at these factors, because the use of proceed bonds, they're delivering on project level transparency, and they're impacting your narratives, which is aligning to the recognition of the categories: renewables, energy efficiency, clean transportation, water and sanitation, enhancing of accountability, and most importantly, ensuring that there is an investor confidence in terms of the bonds that are the green bonds. So the SLBs, then they are embedding the issuer-wide translation accountability. They're aligning the financial cost with measurable progress on outcomes such as emission intensity, energy mix, or even circularity KPIs over a time period. That also brings to another important point, to the standardization and the credibility factors. So here the standardization, when you look at it from the ICMA principles, which are actually global reference for structuring and disclosures and reporting factors. So three important things: structuring, reporting, and your disclosure factors that needs to be taken into consideration. And then there is an SDG linkages, the use of proceeds categories and the SLBs, they can be explicitly mapped to the UN SDGs so as to frame a measurable contribution pathways, and tying it up with the reportedly, the internationally recognized development goals, and how do you measure it in terms of the bonds that are going to be issued, because ultimately the issuer also has to taking all these factors into consideration. And the practical factors that one, or the issuance flow one will looks at is, develop a framework which is aligning with ICMA. Second is securing a second party opinion. Third is about setting the baselinings and the SPTs. Then fourth, you come into including clear languages while you're offering the documents and committing to the locations. And finally, you're looking at the impact of the use of proceeds or the KPI performance based on SLBs, which is the external verification. And from the investor's perspective, when we looks at, the issuer is assessing their credibility via the alignment to ICMA principles, the materiality of KPIs, SPTs, what about the quality of data, what about the reporting cadence, and how these factors are driving the demand and index inclusion and the potential differentials, relative to vanilla bonds. So we'll also talk about in a few minutes down the line about this index inclusion, which is a very interesting factor when it comes down to this world of sustainable bonds that are there. The other factor that comes around is the green finance. When we look at it, the green finance, what is the capitals to the real world impact, the green finance is aligning your cash flows with the climate goals, and is completely looking in terms of moving away from the intent to the measurable and verifiable outcomes. UN environment, which is focusing entirely on the public support of the green financing to financing mechanisms and the microcredit of the sustainable development bond. So what exactly we mean by green finance? That's the first thing that we need to understand. So it's a toolbox, you can say, which is for the market practices and instruments where you're channeling your capital to environmental outcomes, and you're anchoring it to the recognized principles and taxonomies. Both have to be included, the principles as well as the taxonomies, so as to ensure that there is comparability and credibility. Then there are certain core instruments and practices. So you have the use of proceeds such as green, social and sustainability finance eligible projects. You have sustainability linked bonds, which is tying up with the financial characteristics to issuer level KPIs and your sustainability performance targets that are there. Then you have the targets that are underpinning your integrity. So you have ICMA's GBP, your SBP, SBG, SLBP, which we have talked about in the past, where you're setting about the global voluntary proceed guidelines for structuring, disclosing, and your post-issuance reporting, And why does it even matter to the issuers? Because the access to diversified ESG mandates that there should be a signal of transition credibility, and you're going to embed the governance and the allocation and you've got to measure the impact and align with the recognized categories and SDGs. So that's why it actually matters to the issuer. And when you look at it from the investor's perspective, why does it even matter? Because this is a standardized framework to assess the proceeds, your KPI materiality, and the reporting quality. So these three factors where you are supporting your risk management, your stewardship, your potential index inclusion. So when you are trying to do all these things, you are actually avoiding the greenwashing, which we have talked about a lot in depth in past of some of our lectures and around this, where you are ensuring that the eligibility, clarity, materiality, KPIs that are there, and there is a time-bound factor that needs to be taken into consideration. So that brings me to another important point, and that is about ensuring that there is a complete SDG-linked instrument. So, the cost of capital to SDG outcomes, and then when the targets are being met, the finances are staying cheap, because when missed, accountability is showing up higher in the coupon rates. And this is a very well-known fact across the world where people and the investors were dealing in this field. But the question happens to me, what SDG linked instruments are there? And so they're basically performance-based financing. They're SLBs and sustainability linked loans, where the financial terms are they're varying based on the achieving certain predefined sustainability KPIs, which are aligning to your specific SDGs. So all the time, the alignment is towards the SDG goals in this particular space, because the proceeds can be for general corporate purposes. That's the reason why the focus is always on the SDG goals, because everybody is trying to meet that. So you have the UOP or your proceeds rather there, and versus the SDG linkages, because the use of proceeds, bonds is answering what are we funding, and the SDG linked instruments is answering the question, how is the issuer improving your overall, and how is it tying to your coupons and the margins to the outcomes. So there's a complete alignment of use of proceeds and the SDG goals linkages. So again, I talked a few minutes ago about the four pillars. The four pillars from the issuer's lens is KPI materiality. First one, where you're looking at selecting a small set that is reflecting the issuer's largest impact, that is scope, your intensity, what is the renewable share, what about the water intensity, safety rates. The second is about the ambitious SPTs, that you're looking at time-bound targets which are aligning with the credible pathways, where especially in terms of Paris alignment with the transparent baselines and methodologies. The third is the financial meaningfulness, where you're looking at step-ups and downs, or margin rackets which are large enough to be economically relevant and to be clear trigger dates, fallback logic, treatment of mergers and acquisition methodologies and changes. And finally, it's about reporting and assurance. What is your annual KPI reporting? What is the external verification they have done? What is the consistency as far as disclosure of the methodologies and the boundary conditions that you have set? So the investor perspective is looking towards the credibility, which is hinging on your KPI materiality, your SPT ambitions, your verification quality, whether there is a step up in meaningfulness with respect to your spread, your investors, how they are assessing if the targets are meeting your exceeding your business as usual. And when to choose the SDG goal linkages is another important factor, because you see the entire game is around the SDG puzzle that needs to be solved. If you clearly see this image, you have the blended finance, you have the green investments, and you have the social impact investments and the private sector. So all of them combined together. This is as per OECD guidelines itself. So when to choose the next SDG linked bond is very important, because it has to be useful when capex is hard to ring fence, or the objective is there and the issuer wide transition is happening. So you have to combine your use of proceeds with instruments for project transparency, plus, and most importantly, for bringing in accountability factor when you're linking it with the SDG goals, as shown in the figure out here. And that brings me to another point, that is about your sustainability linked bonds. So hardwire SDG progress, something we have seen, and you've got to into the coupon that is going to meet your ambitious target, and then you have got to keep the financing cost low all the time, so as to ensure that you have the selection of the right KPIs and you have the calibration of SPTs, that is the sustainability performance target, you have the bond characteristics and the reporting and the verification. So this entire 5 set is the one that is going to be talking about or focusing on the linkages of the bond where actually the performance is mattering. Because the SLBs, what makes them different is the fact that the proceeds from the general corporate purposes and the accountability lies performance, against the KPIs and SPTs that are to be very transparently disclosed, and that it has to be externally verified by the third party, which is actually neutral, as per ICMA guidelines. And unlike the use of proceeds, the focus is going to be on the project eligibility rather, and the reporting allocation or the factors that needs to be taken into consideration. So the KPI selection, the SDG alignment is very important because you are choosing a small set of material which is decision useful KPIs, for example, in terms of emissions, intensity and all that stuff, and you're explicitly mapping it to the relevant SDG targets to ensure the relevance and avoiding the immaterial metrics gaming that is there. So the financing mechanics that really matter is where you're defining your meaningful coupon step ups or step downs. You're testing your economic relevance, which is relative to the issuer's typical spread that is there. What is specific to observation dates, fallback rules, how will you treat the methodology changes, your M&A impacts on the bond documentation. Then, we talked about the reporting and the verification, which is also about your understanding your committing to the annual KPIs and performance reporting. How will you obtain an external verification? What are the outcomes that are there? How will you provide your transparent impact narratives so as to support your stewardship and index inclusion? Again, these are based on the various ICMA guidelines that have been set up, recommendations and the disclosure factors that ICMA recommends heavily into it. And then we come down to another important factor, and that is about your sustainability linked instruments, where you're looking at when the KPI moves in the coupon. So hardwiring issue and transformation is there, the cost of capital, and they are trying to meet the ambitious target to keep the coupon low. So when we look at it, so the design philosophy and the scope is around sustainability linked instruments or SLIs, so as to make the pricing contingent on issuer level and the KPI performance against predefined sustainability performance targets, which is unlike your use of proceed bonds. And the proceeds can be for general coupon corporate purposes, where you're looking at in terms of accountability, which is shifting from what is funded, what is being achieved. So there's a complete linkages from funding to linkages to achievement. So that linkages has to be drawn completely. And then you have to design the philosophy and the scope. So sustainability linked bonds, they're making the pricing of the contingent on issuer level, the KPI performances that are there, which have been defined, predefined sustainability performance targets, which are unlike your use of proceed bonds, which is ring fenced for the funds to projects, and the proceeds can be for general corporate purposes, where you're looking at accountability, which is shifting from what is being funded to what is being achieved. So that complete bridge has to be built, and you have the SPT calibration and the credibility, where the calibrated SPTs are ambitious, time-bound trajectories, which are exceeding your business as usual disclosures. Your baselining methodologies, when you're looking at the locking the observation dates, what is occurring well before the call dates, how will you provide the rationale referencing recognized pathways, which is actually based on the Paris consistent structure curve. Then you have the coupon linkage mechanics, where you're making the financial variations more meaningful in terms of coupon step ups and step downs, redemption of the premiums, the multi-trigger structures, typical when you look at it typically from the market clustering, you have it's generally up to 25 BPS, that 25 basis points that step up or step down generally takes place. This is again a rule of thumb, nothing very specific in this regard. Where the average is near around 31 BPS across large samples when you look at it. So the reporting and verification and assurance, where you're committing to at least annual KPI reporting with the external verifications. and you're specifying verifier scope and standards that are being used. The investor due diligence, another interesting and important factor that needs to be taken into consideration, is very important because the pricing dynamics is going to come from there, because the investor triage on KPI materiality, SPT ambitions, and economic significance of penalties are very important, because the secondary performance and reception is depending more on the credibility of the label alone. That is a very, very important factor. So the investor is always trying to evaluate correlation of penalties, the coupons, and the credit quality, and is trying to de-minimize the step-ups that are less effective in high-yield context where the coupons are tighter, or rather higher. And you're setting the ambitious SPTs with your transparent baselines where you're looking at model economics so as to ensure step-ups are more meaningful, and you're setting up early observation dates and minimizing your call with features which is undermining your accountability. These are the important factors when you look at the sustainability linked instruments. So another important thing that I said was about the ICMA principles and SDG mapping, which we have been stressing over and over again, because you're anchoring your bond framework in ICMA principles, and then you're mapping your outcomes to the SDGs, and the entire factor relates to around the ICMA principles. So let's try and understand what these ICMA principles are all about. So they are providing you a harmonized framework for both for the issuer as well as for the investor, because they are providing structure, disclosure, and reporting and verification of based on your green social sustainability, and which is actually you're focusing on the use of proceeds and your sustainability linked bonds. So for UOP, that is your use of proceeds, which is requiring your clear eligible categories, selection of governance, ring fencing of the management of proceeds, allocation of impact reporting. For the SLBs, you are requiring your issuer level KPIs and ambitious SPTs, we're looking at economically meaningful coupon term variations, defining your observations dates, what are the external verifications. And then comes in the important point of SDG mapping. So you have the ICMA principles which has to be mapped into the SDG principles. Let's look at it from how do we do that, because you're looking at mapping eligible categories of your use of proceeds or KPIs or SPT to specific SDGs, wherever possible, looking at SDG targets, say SDG 7.2, which is talking about renewable share, and SDG 13.2, which is talking specifically in terms of climate action planning, so as to avoid various vague claims that might occur. Then you have the use of one to few mapping, where you're prioritizing your 1 to 3 most relevant SDGs as per category or KPI to maintain specificity and prevent your SDG washing. You have the disclosure methodologies and the boundaries, which comes in terms of your scopes, intensities, absolute metrics, baselining, geographies, and you're trying to keep them consistent year over year. And therefore, the investor due diligence checklist, when you're looking at from the use of proceeds, and then the SLBs, so there are two important factors which you need to look at from the investor's perspective. And there they are looking at, in the first case of use of proceeds, it says then, are categories eligible per ICMA? Is the project selection been robust? Are proceeds tracked and reported with allocation and impact of the metrics? Three most important factors that you need to consider. Then you have the SLB, which is looking at are KPIs material? Are SPTs ambitious and time bound? Is the step up meaningful versus credit spread? Are verification and fallback rules clear in this regard? So the investor due diligence checklist is going to be the most important factor, and that's where the ICMA guidelines becomes very, very important for any kind of an insurer. That also brings me to another point, is that of the ICMA green bond principles, so which is looking at structuring and disclosing and verifying your reporting based on the ICMA green bond principles. So now when you look at this diagram, it clearly states the various factors, the green bond principles, the social principles, the sustainability guidelines, and most importantly, how again you're going to link it to your SDG goals and the sustainability linked bonds that are going to be there. What are the principles around it? What are the financial instrument guidelines? And what is the thematic guidance that needs to be taken into consideration? So what is GBP and why does they matter? So the GBP is actually providing your green bond principles. They are actually providing your harmonized and voluntary framework that the issuer is going to define your eligible green projects, governance of selection, proceeds of tracking, the post-issuance disclosures, so that the investors can assess credibility and impact consistently. So there are 4 different core components that we need to look at it. First is your use of proceeds, where the issuer must be very specifically eligible to green categories and exclusions, and explain how the proceeds will be allocated to new financing or refinancing, and how these categories will align with your environmental objectives, more precisely in terms of your SDG goals that needs to be aligned. Then comes in the second component, which is the second core component, where you're looking at project evaluation and selection. So the issuer should outline decision processes, the eligibility criteria, the environmental objectives, the management of the material, environmental and social risks while you're doing your selection proceeds, how you're doing it, why you're doing it. All that has to be specifically defined as per the Green Bond Principle, GBP. Then you have the third core component, which is talking in terms of management of proceeds. So the proceeds should be tracked via internal systems with the transparency on temporary placements of unallocated funds and an expected, the allocation timeline until now, how they have been fully deployed. And then you have the fourth core principle, which is talking in terms of reporting, something again we'll talk in detail a few minutes down the line, where you're looking at least an annual reporting on allocation and where feasible impact matrices and methodologies and the disclosure baselines with the assumptions and calculations and approaches for decision making being useful. So these four components has to be aligned with the review processes, which is going to come from the external factors. So external reviews and assurance, which Green Bond Principle is encouraging your second party opinions, verification, certification, your green bond scoring, so as to enhance your credibility. How should the issuers publish your reviews? What are the specific scopes and standard principles that needs to be applied? How do you link this to your SDG goals and the various taxonomies around it? What are the best practices? How many issuers may be eligible to categorize your UN SDG goals? You're referencing your regional taxonomies so as to strengthen your impact narratives. The best practice issuer workflow that needs to be drafted off. So when you're drafting your green bond principles, what are the alignment of the framework? How will you obtain a second party opinion? What are the set allocation targets and impact of the KPIs you're looking at? How will you disclose it in the offering documents? How will you report it in the allocation and the impact that is going to be there? What is the annual and external assurance, and which are very, very relevant for this entire thing? So this green bond principle is actually as per the ICMA principles that are going to be coming around. And in the similar lines, when you look at it, is the another factor, that is your sustainability linked bond principle, SLBs, where you're designing your KPIs and SPTs so as to move with the coupon. So pick a few KPIs that actually matter to you in terms of your SPTs and then make them coupon care. That's what the entire idea. So your KPI has been set, your coupon has been ratcheted up. That means there are more common consequences of missing the KPIs. Then you have the reporting undertaking, which is unusual for the undertakings to provide lenders and the contents to the third party reporting, and the events of default, what happens, So when you look at it from the KPI materiality factor, it is reflecting on the issuer's legal largest sustainability impacts or transition levels that are going to be there. It can be in terms of scope 1 and 2, or even 1 only, or even 2 only. The emission intensity, the renewable share, the water intensity. Then the second factor is about decision usefulness for the investors, which is consistent over time, and most importantly, it is auditable from the investor's perspective. How will you avoid your vanity matrices that are there? It's not going to impact your enterprise value or SDG outcomes. How will you select your right KPIs? So you have to actually define your 2 or 3 different well-defined KPIs altogether, which are actually going to outperform your long list of KPIs that you may have taken into consideration, because particularly when you're looking at the quality of data that has to be taken into consideration, going to be a big challenge. Then you're going to set your SPT ambition and the calibration, where you're looking at set time-bound trajectories that are exceeding business as usual and aligning with the credible pathways. In particular, take the case of Paris alignment, sector curves that are there. Then making the coupon economically meaningful, again, defining your step up, step downs, variations that are material relative to the issuer's spread. How will you use the multiple observation dates to reduce all or nothing risk and keep incentives throughout the life cycle for the bond? Specifically, how will you fall back on the logic that you need to take care for methodology changes, restatements or M&A to incentivize that cannot be gamed, documentation essentials that needs to be taken into consideration. Okay, your KPI definitions, your baseline, SPT formulas, observation dates, your step-up magnitude, your data sources, verification commitments, treatment of the corporate actions, what are the clear disclosures in the framework and offering documents that are eligible for comparability across the industries and the sectors in particular when you are aligning again with your SDG goals. What are the reporting and the external verification factors that you have taken into consideration? How will you publish your annual KPIs all over again? What about the use of proceeds and the SLBs and the complementary roles that has to be taken into consideration? So your sustainability linked bond SBP that you call as, how are they taken? This is the main framework when you're looking at it from that perspective. Another important point is in the similar regard is the disclosure and reporting. Something is very, very important because that is where the credibility of your sustainability debt comes into picture. So what gets disclosed gets trusted, and that is where the allocation, impact, KPI performance is going to be measured. If you're going to report the labels and you're going to figure out the investability factor, the verifiable claims that are going to be there. So because you're looking at what report for use of proceeds, what to report, that's the important factor. So you're looking at allocation reporting, you're looking at impact reporting, and the governance and control. Three factors, So let's look at each one of them at one time. So when you're looking at allocation reporting, you're looking at in terms of amounts that have been allocated. What about the share of financing versus refinancing, unallocated balance and temporary placement, expected allocation timeline to full deployment per ICMA guidelines. Then impact reporting, you're looking at quantitative indicators where feasible, say example of megawatt of renewable energies that have been converted out or has been pumped into the energy grid. What are the trillion carbon dioxide that has been avoided altogether? What amount of water has been saved? How many gallons of water has been saved? You have got to have a clear baselines. The calculation methodologies has to be very precise and has to be clearly stated, and any assumptions or data limitations has to be spelled out very clearly. Then comes in on the similar lines, you come to the governance and controls. You're describing the project selection processes, your environmental objectives, what are the management of environment and sustainability risks, plus how will you internally track the system for the use of proceeds of management. Then comes in second point is about, once you've done your what report for sustainability linked instruments. So again, here you have got three factors: your KPI performance, your outcome verification, and the structural terms that you need to take into consideration while setting up practice. So when you look at the KPI performance, you're looking at annual disclosures of actual KPI values versus baselining, with the clarity on scopes, boundaries, methodologies used, alignment with the timing to observation dates in the legal terms. In the terms of outcome verification, you're looking at external assurance of KPI outcomes, again SPTs, with the verifiers, scope, standards, opinions published, and what has been referenced for the investors' review. Structural terms in terms of practices, because you're looking at disclosure trigger mechanics, coupon margin adjustments, fallback rules, methodologies, changes on M&A, treatment or restatement to prevent your ambiguity or gaming. The third fact is going to be coming around in terms of your reporting is going to be around your avoiding the greenwashing, which is going to be very important because you're going to have a voluntary disclosure systems into place. Here again, looking at three different things: specificity over slogans, timeliness and consistency, and decision useful detail. So when you look at specificity over slogans to avoid greenwashing, you're looking at how you're going to tie each reported metric to ICMA aligned categories of UOP, that use of proceeds, or to the defined set of KPIs, SLBs and SLPTs, so as to avoid a vague SDG goal alignments. And the timeliness and consistency is another important factor, because you're looking at out here at least the annual reporting with consistent metric definitions, comparable baselines, transparency in terms of restatement of the policies, the delays or the infrequencies that updates, which will actually undermine the credibility. What about the decision useful as far as the details is concerned? You have got to include your methodologies, your decision factors, data sources, the geographic and the organizational behaviors, so as to ensure that the investors can reproduce or audit their calculations. And the fourth point is the documentation and review best practices. You've got to have a pre-issuance where you're looking at publishing an ICMA aligned framework and trying to obtain a second party opinion, where you're trying to clarify your alignment with the KPI materiality, SPT ambitions, which are very relevant. Post issuance, you're looking at providing allocation impact on the UOP, that is user of proceeds, so as to report annually with external verification, maintaining an accessible archives so that investors can track progress, and most importantly, address known loopholes. So you want to set observation dates which are early enough so as to ensure that the penalties are economically meaningful, and they are going to, and you can codify whatever is the change of methodology, whatever is the integrity factors that needs to be taken into consideration. Now, that brings me to another important point, is the various kind of instruments that are going to be there. So you are looking at, one of them is the green bond. So where the funding actually moves to the needle, you're trying to point your capital at proven climate levers, and then you're trying to look at watts, liters, and tons that the investors can actually trust in terms of, and when you look at the green bond market across the sectors, you show issuer outlook and their regional factors and their sector outlook altogether. So the question happens to be, what is eligible and what is really going to be covered, So the real renewable energy, if you look at it in terms of the utility and distributed solar, wind, geothermal, certain types of hydro, what are the impact in terms of KPIs such as megawatt hour generated, trillion carbon dioxide avoided, how much is the grid emissions factor that has been used. Then energy efficiency is another important point in the eligibility categories. You're looking at industrial process upgrades, building of the retrofits, your smart grids, KPIs, energy saved in megawatt, intensity reductions, how will you avoid your double counting with the green buildings. Third is on the clean transportation, when you're looking at it, how much of electrification of rail has happened, what about the metro, EV buses, what are the charging points, what are the modal shift in the infrastructure. KPIs will measure it as the passenger kilometers shifted, fuel that has been saved, how much is the trillion carbon dioxide avoided, disclosure usage assumptions has to be there. The green buildings, if you look at it, the certified new buildings or retrofits, which is best class with the energy performance. So another factor is capex versus refinancing. Why does it actually matter? Because new capex means finances are incremental green assets. You're prioritizing your forward-looking capacity additions, clearly stating your allocation timelines and your temporary placement of unallocated proceeds as per GBP. You're refinancing because there you are supporting your existing eligible assets. You're disclosing your look-back periods. You're looking at the asset vintage and everything else and the proportion of refinancing that is required. And in the blended structures, many programs such as mix of capex and refinancing is going to provide you a percentage split and the rationale so that the investors can judge the transition and the momentum that is there. The third factor on the similar lines on the green bonds is going to be around the structuring for the credibility. There we have a very specific in terms of name categories, the threshold standardization, your exclusions, your alignment with GBP, where is it helpful, what is the recognized taxonomy standardization, the governance, looking at describing your project evaluation, your selection processes, your environmental sustainability, risk management, internal tracking systems, and for the proceeds, how will you have the reporting discipline, and the fourth important point on the similar line of the green bond is around the investor diligence. So what will they check? Essentially they'll be looking at eligibility, clarity, and thresholds because of the proportion of capex versus refinancing and the look back, the data quality of the impact metrics that needs to be taken into consideration. The sustainability linked bonds is another thing on the similar link of the green financing bonds that are there. So now if you see the growth that has been happening over the years on the sustainability linked bonds, SLBs, and the various sectors that have been appropriately shared out, because you're selecting your material KPIs is where the issuer and investor lens comes into picture, because you're choosing two or three different KPIs that are reflecting your issuer's largest sustainability levers, and you're mapping each of the KPI to a specific SDG target. So again, repeating myself, SDG 13.2 for climate action, or SDG 7.2 for specific geographies, and for renewables, SDG 6.4 for water efficiency. So that has to be brought into consideration with the measurable, the geographies, the impact assessment that needs to be taken into consideration. While setting the ambitious SPTs, you've got to calibrate and pass through the scrutiny, because often one tends to set up a very ambitious target, because SPTs must exceed business as usual and we must be time bound, and it has to align with the credible external pathways. So say for sectoral decarbonization, we're going to publish the baseline year, the data sources, the methodology, and the various waypoints for transparency. And that is where the comparability has to come into picture, because you're now explaining why the SPT is ambitious versus the past performance and the peers. And you're stating how methodology is going to change for, that will be handled by to preserve your integrity and the continuity of the targets. And the fallback and remediation is going to be another important if the targets have been missed, because fallback provisions have to be specific. How data is, what was the data restatements, what was the methodology updates, boundary changes that were treated, inclusion of verifiable endorsement adjustments, appropriation, transparency disclosures, what was the recommendation toolkit that was taken into consideration. So whether you considered your cumulative step-ups, additional reporting commitments, achievement of the logic. Then you have the reporting and the verification, where you're looking at the credibility of, which is bringing in your credibility engine itself actually. And that is where you're committing to at least an annual KPI performance reporting with the external verification of outcomes against SPTs, and you're synchronizing your publication with the observation dates. That brings us to another important point, and that is about your various, the market structures around this entire goals of the green bonds that are there. And one of the things that we're going to be talking about is the sovereigns and the sub-sovereigns. So the sovereigns and sub-sovereigns, when you look at why the public issuer matters, because the sovereigns and the municipalities, they translate climate and development policy into your investable pipelines, where they are using their ICMA principles to standardize eligibility, governance, reporting across the diverse sectors, such as your transport, water, building, adaptations, and then the alignment to ICMA facilitates, where you're looking at investor diligence across borders, and you're reducing greenwashing risk, supporting index inclusion, benchmarking the building for public sector sustainability. The framework architecture for sovereign and municipalities is very important, because here the use of proceeds, you're defining the eligible criteria, you're setting the evaluation, selection governance, you're tracking the proceeds, you're committing to annual allocation and impact reporting as per ICMA's 4 pillars that are there. The sustainability linked options that are there were used, setting issuer level KPIs, calibration of ambitious SPTs. Then the category focus, typical for the public issuers in terms of infrastructure heavy pipelines, so as to map your ICMA recognized categories. You have to have a clean transport, in terms of say clean transport or buildings or renewable energies. So the clear category definition and exclusions has to be mentioned and has to be mapped out. The reporting discipline has to be maintained in terms of your annual allocation reporting with look back windows and capex refinancing splits, the external reviews that has to be taking place in this regard. Then you have another way of doing it is your project SPVs, where you're ring financing your risk and you're funding your impact, So why SPVs for green bonds? Because SPVs, you enable your ring-fenced funding, where the bond proceeds, they're going to be contractually tied to specific eligible assets, and such as renewables, clean transport, water projects, and it is going to align directly with ICMA's use of proceeds model transparencies. Then again, you're going to align your SPV to framework of ICMA, because you're defining your eligible categories in terms of SPV green financing framework and describing your governance for project evaluation and selection, including your environmental objectives and risk management. The reporting that the investors are expecting, because you're looking at providing at least annual allocation reporting wherever feasible, and the impact reporting or the method, baselining, assumptions. For multiple SPVs, you're disclosing your project level contribution, avoiding any double counting across categories. You've got the external reviews and verifications, where you're obtaining a second party opinion to get a pre-issuance to assess the alignment with the green bond principle GBP, and you're trying to publish your scope and the exclusions for investor scrutiny. Post-issuance, you're considering external verifications of allocations and selected impact of the metrics that are there so as to ensure you're strengthening your integrity and reducing your perceived greenwashing risk. Then another important point in the similar regard is ICMA alignment, because in ICMA, to make structured, comparable and disclosures decision useful and investor diligence is fast and eligible. So when you're looking at ICMA alignment, it actually means your issuers is committing to the principles-based framework that is standardizing how eligible activities are predefined or as per UOP, and how your issuer level performance is measurable, enabling cross-issuer comparability, alignment with the signals that are external reviews that are there, transparency of the methodologies, the periodic reporting, the investors can audit and benchmark. What about the core elements of UOP, use of proceeds, where you are precisely defining your eligible categories and exclusions and disclosure, capex versus refinancing your splits, and looking back periods, your evaluation and selections, where you're describing your governance, decision criteria, environmental objectives, environmental and social risks, behind the project choices. What about the management of proceeds, where you're implementing your tracked accounts or systems and disclosing your temporary placement of unallocated funds and setting the allocation guidelines. So you have the core elements of the SLB is alignment with there. So you're looking at KPIs, selecting a small set of material, measurable, consistent and auditable, preferably mapped to relevant SDG targets. You have the SPTs, where you're setting your ambitious and time-bound targets with that are exceeding business as usual, aligning with the credible pathways. Then you have the bond characteristics, which are where you're defining your meaningful coupon, step-ups, step-downs, as we talked about, 25 to 31 BPS. In terms of variations with the clear observations, with the rates and the risks that are associated, reporting and verification. Because you see, the ICMA alignment is very important for any investor, because here it is reducing your greenwashing risk by anchoring disclosures, and you're trying to recognize your processes by improving your comparability and stewardship and index eligibility across the jurisdictions. So the ICMA alignment, as we were talking about, is about the investor, blueprint and due diligence, and how do we make sure that it's more reliable. So it actually means that the issuer is committing to the principles that are based on the framework that are standardizing how eligible activities are been defined as per user offer proceeds. More precisely, how user issue level performance is being measured by SLBs, while you are enabling your cross-issuer comparability. That's the focus, And when we look at the alignment signals, we're looking at external reviews, to transparent methodologies, to periodic reporting, to ensuring that the data is clean and organized, how the data has been collected, why has it been collected, what are the methodologies, what is the approach regarding the reporting, what are the risk factors that has been taken into consideration. So all this is talking about alignment with respect to ICMA. And then the core elements in terms of the UOP alignment, when we look at it, so there are essentially 4 things that one needs to consider. One is the use of proceeds. So here we are looking at precisely defining eligible categories and exclusions and disclosures, capex versus refining the split and looking back periods. The second is evaluation and selection, where you describe your governance, the decision criteria. What about the environmental objectives, the environmental and social risk controls which are behind the project choices. The third is around the management of proceeds, where you're looking at implemented track accounts or systems, the disclosure, temporary placement of unallocated funds, and the set of allocation timelines that one needs to take care of. And fourth, and most importantly, as I've always been insisting on this particular lecture, is regarding the reporting and the disclosures. So here you're looking at least providing one allocation or reporting factor. Where is it feasible? How is it feasible? What are the factors that one needs to take care of when it's doing this reporting? What are the criteria that have been set around? What are the baselines, methodologies or methods, and what are some of the assumptions that one has made in terms of decision making while preparing the reports and having the disclosures around these reports? So when you come to the other aspect of the ICMA alignment, that is the core elements of SLB alignment, there again, there are 4 different factors we look at it. One is in terms of KPI. That is the selecting a small set of material which is measurable, consistent and auditable, preferably mapped to the relevant SDG targets, because ICMA alignment is all about the SDG targeting and alignment. The second is SPTs, which is where you're setting your ambitious, rather, time-bound targets that are exceeding business as usual, and you're aligning your credible pathways so as to disclose the baselines and the methodologies. The third is the bond characteristics, where you're defining the meaningful coupon step-ups and downs, or the veteran, or rather the term variations with respect to your clear observations of dates, the fallback logic, the risk controls, the risk measurements, the baselining that has been taken into consideration. And then comes in the most important point is around the fourth is around reporting and verification, where you are committing to your annual KPI updates, and the external verification with respect to your outcomes against SPTs, and publishing your verifiable or verifier reports and scopes and standards. So these are the four things that one needs to consider when one is looking at in terms of SLB alignment, because the ICMA alignment is actually mattering most to the investors, because they are looking at reduction in how will you reduce a greenwashing risk that is there, how will you anchor the disclosures, what are the recognized processes, how will you improve your comparability, the stewardship, the index eligibility across the jurisdictions, what are the clarifies, how will you clarify with respect to your expected post issuance, the allocation impact for the UOP, the KPI performance for SLB, the streamlining of the portfolio and the monitoring and engagement factors. So this actually is the approach that one needs to take care of as far as ICM alignment is concerned, because when you look at this diagram, it shows very clearly the approach to allocating the proceeds to green or social projects, to achieving low forward-looking sustainability target, and the pathway that one needs to take in order to have the use of proceeds and the sustainability-linked bonds which have been aligned to ICMA. So the next factor that one needs to take care of, and I've been insisting over and over again, is the index inclusion. So this is where the turning of the principles is taking place into the placement factors, because as you're aligning your ICMA to make structures comparable, disclosures, decision useful, and investor diligence fast and reliable. And this is where the reliability factor of the index inclusion comes into picture, because that is why does this index inclusion even matter? Because index eligibility is going to broaden the buyer base through passive and benchmark awareness of the funds. How will there be an improvement in liquidity? How will you potentially reduce your new issuance concession? What are the long-term funding costs? And where are you going to combine them with the credible disclosures? And then the second point in this regard, the inclusion matter is basically consistency principle, which is where you're aligning to your reporting, which is creating a machine readable fields, so as to make sure that the use of proceeds, the impact of KPIs and SPT outcomes are measured, the index rules, the data vendors that can be systematically ingested. Then comes in the alignment with signals, index ready quality out there. So for green use of proceed bonds, for clear, have to clear eligible categories. How will you track your proceedings, annual allocations, impact of reporting as per ICMA GBP, so as to make the securities easier to classify across green index methodologies. For SLBs, ICMA pillars that are there in terms of material KPIs, setting up of the ambitious SPTs, meaningful coupon variations, reporting, external verifications. Then comes in the most important factor is around the documentation of this thing, because public ICMA aligned framework and the second party opinion and offering of the documents that explicitly state eligibility, data boundaries, and reporting cadence actually enable for the faster inclusion of reviews that have been done by the second party in the audit process. And therefore, the SLBs and the term sheets will specify your KPIs, your SPTs, your observation dates, the step mechanics that are around it, and the verification of the commitments, which will help your indexing of providing the confirmation with respect to performance-linked classification. So let's look at one of the websites in this regard, which is very popularly used, and have a look at how this index inclusion can be done. So I will take everybody to this particular website, and I will request the viewers to go to this website and check it out. So this is a very interactive website where you can do your index inclusion. So they have the selective green bond index, which is a rule-based. Multiple of them are there. So I've taken one of them, which is actually based on the market value weighted engineering so as to mirror the green bond market. And the index is calculated on the total return index, which has been denominated in USD. So here you can clearly see the chart and where you can do an interactiveness with, say, let's take the 1 week, and you can also play around with your data, date points as well. So let's take this case of 1 month, how index has moved, and also 5 years movement. And it's pretty interactive where it gives you the exact valuations that has been happening for over a time period. You can also set your time period out here. Say if I want to set it up till, say, I just want to take the last 3 years. So I change this thing and I make it 2023. Just make a small change out here, 23, and that is it. It gives me last 2 years of data points across the board. So you can change this thing year to day, mark as well as the maximum changes that occurs. So here you have an entire detail about the master data that they have used, the current quotes that are available, the Sol Green index that is there, which is coming from the Bloomberg ticker, the ISIN number, and then you have the index composition as well, where they clearly state how they have done it, what are the name of the entities that they have considered while creating this index. There are few announcements that one can look at it. The documentations around the compliance, ASG method statements, fact sheets. So one can go here and check out each and every one of them. All the details that are available across the board as far as this green index is concerned, inclusion index is concerned. A pretty useful and a pretty important website for anybody who's trying to understand this space of green bonds and sustainability linked bonds with respect to the most important factor of index inclusion. And that brings me to the final point of this lecture, and that is how the value proposition about the data and the digital field, because here this is what the engine is going to be, and where your credibility of the entire sustainable finance is going to be around. So this data and digital is the one that is the engine that is going to be giving you credible, sustainable finance, and because you're looking at turning the disclosures into data, interoperable taxonomies, and the machine readable readiness impact reports, which is going to come from your faster diligence, index inclusion, and the next gen performance of the linked products. This is the main focus. We're looking at spatio-temporal patterns to all kind of effects, mechanisms, reliance on policies, recommendation. This is what is our digital green finance and development is going to be around. So it's going to be around digital finance, green development, digital financial impact effects, and the energy structures, and the digital how is it going to support promote your green development approach, because you see the data and the digital world is going to be the important factor, because better ESG data means you're going to move from PDFs to pipelining. Essentially, you're going to move towards more of a real-time data analysis, because the pipelines would be available on the real-time data. So there's going to be a shift of narrative from PDFs to more structured, machine-readable fields. This is going to come in various formats, such as it can come in format of JSON or CSV readable, or even Excel readable formats, or even you can pull data from the various websites in the real-time system, and also you can include data from your databases which are existing, so that the application impact is there. The KPIs have been defined, the baselines have been there, the methodologies are there, so that the analysts can recompute the metrics and automate the checks. There's going to be a standardization of the units and the factors that is going to be there, the disclosure of the emission factors, the boundaries that are going to be set. The second is going to be around interoperable taxonomies, because you're going to be mapping once and reusing everywhere. So your map eligibility criteria so as to recognize your taxonomies, such as ICMA categories, regional taxonomies, and mapping it out to the SDG targets, one to few approach. The machine readable impact reports decision, which is going to help you in decision making, which is going to be very useful for the design perspective, because you'll be able to publish your annual reports with allocation of the tables, the project IDs, the look back periods, capex versus refinancing splits, verification and provenance of governance. It's going to lead towards a sustainability linked securitization and performance-based products, because the performance-linked ABS and MBS, they're tying you to your tranche coupons or credit enhancements to pool level KPIs, where you're building your energy intensity, portfolio emissions, contingent on verified outcomes, the outcome indexed notes, derivatives, the payer and receiver legs, which have been linked to the verified KPI paths, the data prerequisites in terms of standardization of KPI definitions, verifiable baselines, the investor and the index benefits that are going to be there, because in terms of the faster screening, apples to apples comparisons and the automation as far as the alerts or missed SPTs or late reports are concerned. So these are some of the factors that brings this data and the digital world a very important factor as far as the green bond, the sustainability linked bonds are concerned. And then the entire approach towards the digital finance, because the green economy efficiency is what one is looking at. So that brings me to the end of this lecture on this lecture series of ESG analytics and green finance. Thank you. My name is Atul Tripathi and I am an honorary adjunct fellow at National Maritime Foundation. Swayam Prabha is a very good channel to be associated with, not only as an educator but also as a student. It gives you an opportunity to learn new subjects from industry experts like myself, and also from various professors who are there and experts who are there in the field. So this is a new course that I'll be teaching. It talks about ESG, it talks about the analytics around ESG, it talks about the various green financial instruments that are there. We'll talk about risk pooling, we'll discuss about what is the nature of weather indexes, what is the nature of finance that is happening, how is the industry looking at it, what are the legal perspectives, what are the technological perspectives, and also most importantly, what is the analytics perspective that we'll be bringing it out. Swayam Prabha has this government website which is called swayamprabha.gov.in. All you need to do is go down, drill it out, figure out which course is most appropriate for you, so that you can find out the best one that is available and which is most applicable for your area of learning. As far as this, the way it is challenged, it is transforming the entire education system, because you see there are a lot of people out there who are spread across the country and they want to get access to good quality education given by professors, experts. This is one of the very good channels to be in.